The Second Bank of the United States, 1816 to 1833. The United States emerged from the War of 1812 in a chaotic monetary state, with banks multiplying and inflating ad lib, checked only by the varying rates of depreciation of their notes. With banks freed from redeeming their obligations in specie, the number of incorporated banks increased during 1816 from 212 to 232. Clearly, the nation could not continue indefinitely with the issue of fiat money in the hands of discordant sets of individual banks. It was apparent that there were two ways out of the problem. One was the hard money path, which was advocated by the old Republicans and, for their own purposes, the Federalists. The federal and state governments would have sternly compelled the rollicking banks to redeem promptly in specie, and, when most of the banks outside of New England could not, to force them to liquidate. In that way, the mass of depreciated and inflated notes and deposits would have been swiftly liquidated, and specie would have poured back out of hordes and into the country to supply a circulating medium. The inflationary experience would have been over. Instead, the Democratic-Republican establishment in 1816 turned to the old Federalist path, a new central bank, the Second Bank of the United States. Modeled closely after the first bank, the Second Bank, a private corporation with 1/5 of the shares owned by the federal government, was to create a national paper currency, purchase a large chunk of the public debt, and receive deposits of Treasury funds. The Second Bank of the United States notes and deposits were to be redeemable in specie, and they were given quasi-legal tender status by the federal governments receiving them in payment of taxes. That the purpose of establishing the Second Bank of the United States was to support the state banks in their inflationary course, rather than crack down on them, is seen by the shameful deal that the Second Bank made with the state banks as soon as it opened its doors in January 1817. At the same time that it was establishing a new bank in April 1816, Congress passed a resolution of Daniel Webster, at that time a Federalist champion of hard money, requiring that after February 20th, 1817, the United States should accept as payments for debts or taxes only specie, Treasury notes, Bank of the United States notes, or state bank notes redeemable in specie on demand. In short, no irredeemable state bank notes would be accepted after that date. Instead of using the opportunity to compel the banks to redeem, however, the Second Bank of the United States, in a meeting with representatives from the leading urban banks, excluding Boston, agreed to issue $6 million worth of credit in New York, Philadelphia, Baltimore, and Virginia, before insisting on specie payments from debts due to it from the state banks. In return for that agreed-upon massive inflation, the state banks graciously consented to resume specie payments. Moreover, the Second Bank and the state banks agreed to mutually support each other in any emergency, which of course meant in practice that the far stronger Bank of the United States was committed to the propping up of the weaker state banks. The Second Bank of the United States was pushed through Congress by the Madison administration, and particularly by Secretary of the Treasury Alexander J. Dallas, whose appointment was lobbied for that purpose. Dallas, a wealthy Philadelphia lawyer, was a close friend, counsel, and financial associate of Philadelphia merchant and banker Stephen Girard, reputedly one of the two wealthiest men in the country. Toward the end of its term, Girard was the largest stockholder of the First Bank of the United States, and during the War of 1812, Girard became a very heavy investor in the war debt of the federal government. Both as a prospective large stockholder and as a way to unload his public debt, Girard began to agitate for a new Bank of the United States. Dallas's appointment as Secretary of Treasury in 1814 was successfully engineered by Dallas and his close friend, wealthy New York merchant and fur trader John Jacob Astor, also a heavy investor in war debt. When the Second Bank of the United States was established, Stephen Girard purchased the $3 million of the $28 million that remained unsubscribed, and he and Dallas managed to secure for the post of president of the new bank their good friend William Jones, former Philadelphia merchant. Much of the opposition to the founding of the Bank of the United States seems keenly prophetic. Thus, Senator William H. Wells, Federalist from Delaware, in arguing against the bank bill, said that it was, quote, ostensibly for the purpose of correcting the diseased state of our paper currency by restraining and curtailing the overissue of bank paper, and yet it came prepared to inflict upon us the same evil, being itself nothing more than simply a paper-making machine. End quote. In fact, the result of the deal with the state banks was that their resumption of specie payments after 1817 was more nominal than real, thereby setting the stage for the widespread suspension of the 1819 to 1821 Depression. As Bray Hammond writes, quote, "Specie payments were resumed with substantial shortcomings. Apparently the situation was better than it had been, and a pretense was maintained for its being better than it was. But redemption was not certain and universal. There was still a premium on specie and still a discount on banknotes, with considerable variation in both from place to place." 3 years later, February 1820, Secretary of the Treasury Crawford reported to Congress that during the greater part of the time that had elapsed since the resumption of specie payments, the convertibility of banknotes into specie had been nominal rather than real in the largest portion of the Union. End quote. One problem is that the Bank of the United States lacked the courage to insist on payment of its notes from the state banks. As a result, state banks had large balances piled up against them at the Bank of the United States, totaling over $2.4 million during 1817 and 1818, remaining on the books as virtual interest-free loans. As Cotterill points out, quote, "So many influential people were interested in the state banks as stockholders that it was not advisable to give offense by demanding payment in specie, and borrowers were anxious to keep the banks in the humor to lend." End quote. When the Bank of the United States did try to collect on state bank notes in specie, Bank President Jones reported, quote, "The banks, our debtors, plead inability, require unreasonable indulgence, or treat our reiterated claims and expostulations with settled indifference." End quote. From its inception, the second bank launched a spectacular inflation of money and credit. Lax about insisting on the required payment of its capital in specie, the bank failed to raise the $7 million legally supposed to have been subscribed in specie. Instead, during 1817 and 1818, its specie held never rose above $2.5 million. At the peak of its initial expansion, in July 1818, the Bank of the United States specie totaled $2.36 million, and its aggregate notes and deposits totaled $21.8 million. Thus, in a scant year and a half of operation, the Second Bank of the United States had added a net of $19.2 million to the nation's money supply, for a pyramid ratio of 9.24, or a reserve ratio of 0.11. Outright fraud abounded at the Second Bank of the United States, especially at the Philadelphia and Baltimore branches, particularly the latter. It is no accident that 3/5 of all of the bank's loans were made at these two branches. Also, the bank's attempt to provide a uniform currency throughout the nation floundered on the fact that the western and southern branches could inflate credit and banknotes, and that the inflated notes would wend their way to the more conservative branches in New York and Boston, which would be obligated to redeem the inflated notes at par. In this way, the conservative branches were stripped of specie, while the western branches could continue to inflate unchecked. The expansionary operations of the Second Bank of the United States, coupled with its laxity toward insisting on specie payment by the state banks, impelled a further inflationary expansion of state banks on top of the spectacular enlargement of the central bank. Thus, the number of incorporated state banks rose from 232 in 1816 to 338 in 1818. Kentucky alone chartered 40 new banks in the 1817 to 1818 legislative session. The estimated total money supply in the nation rose from $67.3 million in 1816 to $94.7 million in 1818, a rise of 40.7% in 2 years. Most of this increase was supplied by the Bank of the United States. The huge expansion of money and credit impelled a full-scale inflationary boom throughout the country. Import prices had fallen in 1815 with the renewal of foreign trade after the war, but domestic prices were another story. Thus, the index of export staples in Charleston rose from 102 in 1815 to 160 in 1818. The prices of Louisiana staples at New Orleans rose from 178 to 224 in the same period. Other parts of the economy boomed. Exports rose from $81 million in 1815 to a peak of $116 million in 1818. Prices rose greatly in real estate, land, farm improvement projects, and slaves, much of it fueled by the use of bank credit for speculation in urban and rural real estate. There was a boom in turnpike construction, furthered by vast federal expenditures on turnpikes. Freight rates rose on steamboats, and shipbuilding shared in the general prosperity. Also, general boom conditions expanded stock trading so rapidly that traders, who had been buying and selling stocks on the curbs on Wall Street for nearly a century, found it necessary to open the first indoor stock exchange in the country, the New York Stock Exchange, in March 1817. Also, investment banking began in the United States during this boom period. Starting in July 1818, the government and the Second Bank began to see what dire straits they were in. The enormous inflation of money and credit, aggravated by the massive fraud, had put the Bank of the United States in real danger of going under and illegally failing to sustain specie payments. Over the next year, the bank began a series of heroic contractions: forced curtailment of loans, contractions of credit in the South and West, refusal to provide uniform national currency by redeeming its shaky branch notes at par, and seriously enforcing the requirement that its debtor banks redeem in specie. In addition, it purchased millions of dollars of specie from abroad. These heroic actions, along with the ouster of Bank President William Jones, managed to save the Bank of the United States, but the massive contraction of money and credit swiftly brought the United States its first widespread economic and financial depression. The first nationwide, quote, boom-bust cycle had arrived in the United States, impelled by rapid and massive inflation, quickly succeeded by contraction of money and credit. Banks failed, and private banks curtailed their credits and liabilities and suspended specie payments in most parts of the country. Contraction of money and credit by the Bank of the United States was almost unbelievable. Total notes and deposits falling from $21.9 million in June 1818 to $11.5 million only a year later. The money supply contributed by the Bank of the United States was thereby contracted by no less than 47.2% in 1 year. The number of incorporated banks at first remained the same, and then fell rapidly from 1819 to 1822, falling from 341 in mid-1819 to 267 3 years later. Total notes and deposits of state banks fell from an estimated $72 million in mid-1818 to $62.7 million a year later, a drop of 14% in 1 year. If we add in the fact that the U.S. Treasury contracted total Treasury notes from $8.81 million to zero during this period, we get the following estimated total money supply. In 1818, $103.5 million. In 1819, $74.2 million, a contraction in 1 year of 28.3%. The result of the contraction was a massive rash of defaults, bankruptcies of businesses and manufacturers, and liquidation of unsound investments during the boom. There was a vast drop in real estate values and rents, and in the prices of freight rates and slaves. Public land sales dropped greatly as a result of the contraction, declining from $13.6 million in 1818 to $1.7 million in 1820. Prices in general plummeted. The index of export staples fell from 158 in November 1818 to 77 in June 1819, an annualized drop of 87.9% during those 7 months. South Carolina export staples dropped from 160 to 96 from 1818 to 1819, and commodity prices in New Orleans dropped from 200 in 1818 to 119 2 years later. Falling money incomes led to a precipitous drop in imports, which fell from $122 million in 1818 to $87 million the year later. Imports from Great Britain fell from $43 million in 1818 to $14 million in 1820. And cotton and woolen imports from Britain fell from over $14 million each in 1818 to about $5 million each in 1820. The great fall in prices aggravated the burden of money debts, reinforced by the contraction of credit. Bankruptcies abounded, and one observer estimated that $100 million of mercantile debts to Europe were liquidated by bankruptcy during the crisis. Western areas, shorn of money by the collapse of the previously swollen paper and debt, often returned to barter conditions, and grain and whiskey were used as media of exchange. In the dramatic summing up of the hard money economist and historian William Gouge, by its precipitous and dramatic contraction, quote, the bank was saved, and the people were ruined. The Jacksonian movement and the bank war. Out of the bitter experiences of the Panic of 1819 emerged the beginnings of the Jacksonian movement, dedicated to hard money, the eradication of fractional reserve banking in general, and of the Bank of the United States in particular. Andrew Jackson himself, Senator Thomas Hart, quote, Old Bullion Benton of Missouri, future President James K. Polk of Tennessee, and Jacksonian economists Amos Kendall of Kentucky and Condi Rigaud of Philadelphia were all converted to hard money and 100% reserve banking by the experience of the Panic of 1819. The Jacksonians adopted, or in some cases pioneered in, the currency school analysis, which pinned the blame for boom-bust cycles on inflationary expansions followed by contractions of bank credit. Far from being the ignorant bumpkins that most historians have depicted, the Jacksonians were steeped in the knowledge of sound economics, particularly of the Ricardian currency school. Indeed, no movement in American politics has been as flagrantly misunderstood by historians as the Jacksonians. They were emphatically not, as historians until recently have depicted, either, quote, ignorant anti-capitalist agrarians, or, quote, representatives of the rising entrepreneurial class, or, quote, tools of the inflationary state banks, or embodiments of an early proletarian anti-capitalist movement, or a non-ideological power group, or, quote, electoral machine. The Jacksonians were libertarians, plain and simple. Their program and ideology were libertarian. They strongly favored free enterprise and free markets, but they just as strongly opposed special subsidies and monopoly privileges conveyed by government to business or to any other group. They favored absolutely minimal government, certainly at the federal level, but also at the state level. They believed that government should be confined to upholding the rights of private property. In the monetary sphere, this meant the separation of government from the banking system and a shift from inflationary paper money and fractional reserve banking to pure specie and banks confined to 100% reserves. In order to put this program into effect, however, the Jacksonians faced the grueling task of creating a new party out of what had become a one-party system after the War of 1812, in which the Democrat-Republicans had ended up adopting the Federalist program, including the reestablishment of the Bank of the United States. The new party, the Democratic Party, was largely forged in the mid-1820s by New York political leader Martin Van Buren, newly converted by the aging Thomas Jefferson to the laissez-faire cause. Van Buren cemented an alliance with Thomas Hart Benton of Missouri and the old Republicans of Virginia. But he needed a charismatic leader to take the presidency away from Adams and what was becoming known as the National Republican Party. He found that leader in Andrew Jackson, who was elected president under the new Democratic banner in 1828. The Jacksonians eventually managed to put into effect various parts of their free market and minimal government economic program, including a drastic lowering of tariffs, and for the first and probably the last time in American history, paying off the federal debt. But their major concentration was on the issue of money and banking. Here they had a coherent program, which they proceeded to install in rapidly succeeding stages. The first important step was to abolish central banking, in the Jacksonian view, the major inflationary culprit. The object was not to eliminate the Bank of the United States in order to free the state banks for inflationary expansion, but, on the contrary, to eliminate the major source of inflation before proceeding, on the state level, to get rid of fractional reserve banking. The Bank of the United States charter was up for renewal in 1836, but Jackson denounced the bank in his first annual message in 1829. The imperious Nicholas Biddle, head of the second bank, decided to precipitate a showdown with Jackson before his re-election effort, so Biddle filed for renewal early in 1831. The host of national Republicans and non-Jacksonian Democrats proceeded to pass the recharter bill, but Jackson, in a dramatic message, vetoed the bill, and Congress failed to pass it over his veto. Triumphantly re-elected on the bank issue in 1832, President Jackson lost no time in disestablishing the Bank of the United States as a central bank. The critical action came in 1833, when Jackson removed the public treasury deposits from the Bank of the United States and placed them in a number of state banks, soon labeled as, quote, pet banks, throughout the country. The original number of pet banks was 7, but the Jacksonians were not interested in creating a privileged bank oligarchy to replace the previous monopoly, so the number of pet banks had increased to 91 by the end of 1836. In that year, Biddle managed to secure a Pennsylvania charter for his bank, and the new United States Bank of Pennsylvania functioned as a much reduced but still influential state bank for a few years thereafter. Orthodox historians have long maintained that by his reckless act of destroying the Bank of the United States and shifting government funds to the numerous pet banks, Andrew Jackson freed the state banks from the restraints imposed on them by a central bank. Thus, the banks were supposedly allowed to pyramid notes and deposits rashly on top of existing specie and precipitate a wild inflation that was later succeeded by two bank panics and a disastrous deflation. Recent historians, however, have totally reversed this conventional picture. In the first place, the record of bank inflation under the regime of the Bank of the United States was scarcely ideal. From the depths of the post-1819 Depression in January 1820 to January 1823, under the regime of the conservative Langdon Chivas, the Bank of the United States increased its notes and deposits at an annual rate of 5.9%. The nation's total money supply remained about the same in that period. Under the far more inflationist regime of Nicholas Biddle, however, the Bank of the United States notes and deposits rose, after January 1823, from $12 million to $42.1 million, an annual increase of 27.9%. As a consequence of this base of the banking pyramid inflating so sharply, the total money supply during this period vaulted from $81 million to $155 million, an annual increase of 10.2%. It is clear that the driving force for monetary expansion was the Bank of the United States, which acted as an inflationary rather than a restraining force upon the state banks. Looking at the figures another way, the 1823 data represented a pyramid ratio of money liabilities to specie of 3.86 to 1 on the part of the Bank of the United States and 4 to 1 of the banking system as a whole, or respective reserve ratios of 0.26 and 0.25. By 1832, in contrast, the Bank of the United States reserve ratio had fallen to 0.17 and the country as a whole to 0.15. Both sets of institutions had inflated almost precisely proportionately on top of specie. The fact that wholesale prices remained about the same over this period is no indication that the monetary inflation was not improper and dangerous. As Austrian business cycle theory has pointed out, any bank credit inflation sets up conditions for boom and bust. There is no need for prices actually to rise. The reason that prices did not rise was that the increased production of goods and services sufficed to offset the monetary expansion during this period. But similar conditions of the 1920s precipitated the Great Crash of 1929, an event that shocked most economists, who had adopted the proto-monetarist position of Irving Fisher and other economists of the day, that a stable wholesale price level cannot, by definition, be inflationary. In reality, the unhampered free market economy will usually increase the supply of goods and services and thereby bring about a gently falling price level, as happened in most of the 19th century, except during wartime. What then of the consequences of Jackson's removal of the deposits? What of the fact that wholesale prices rose from 84 in April 1834 to 131 in February 1837, a remarkable increase of 52% in a little less than 3 years? Wasn't that boom due to the abolition of central banking? An excellent reversal of the orthodox explanation of the boom of the 1830s, and indeed of the ensuing panic, has been provided by Professor Temin. First, he points out that the price inflation really began earlier, when wholesale prices reached a trough of 82 in July 1830, and then rose by 20.7% in 3 years to reach 99 in the fall of 1833. The reason for the price rise is simple. The total money supply had risen from $109 million in 1830 to $159 million in 1833, an increase of 45.9%, or an annual rise of 15.3%. Breaking the figures down further, the total money supply had risen from $109 million in 1830 to $155 million a year and a half later, a spectacular expansion of 35%. Unquestionably, this monetary expansion was spurred by the still flourishing Bank of the United States, which increased its notes and deposits from January 1830 to January 1832 from a total of $29 million to $42.1 million, a rise of 45.2%. Thus, the price and money inflation in the first few years of the 1830s were again sparked by the expansion of the still dominant central bank. But what of the notable inflation after 1833? There is no doubt that the cause of the price inflation was the remarkable monetary inflation during the same period. For the total money supply rose from $150 million at the beginning of 1833 to $267 million at the beginning of 1837, an astonishing rise of 84%, or 21% per annum. But as Temin points out, this monetary inflation was not caused by the liberated state banks expanding to a fare-thee-well. If it were true that the state banks used their freedom and their new federal government deposits to pyramid wildly on top of specie, then their pyramid ratio would have risen a great deal, or, conversely, their reserve ratio of specie to notes and deposits would have fallen sharply. Yet the bank's reserve ratio was 0.16 at the beginning of 1837. During the intervening years, the reserve ratio was never below this figure. But this means that the state banks did no more pyramiding after the demise of the Bank of the United States as a central bank than they had done before. Conventional historians, believing that the Bank of the United States must have restrained the expansion of state banks, naturally assume that they were hostile to the central bank. But now Gene Wilburn has discovered that the state banks overwhelmingly supported the Bank of the United States. Quote, "We have found that Nicholas Biddle was correct when he said, 'State banks in the main are friendly.' Specifically, only in Georgia, Connecticut, and New York was there positive evidence of hostility. A majority of state banks in some states of the South, such as North Carolina and Alabama, gave strong support to the bank, as did both the Southwest states of Louisiana and Mississippi. Since Virginia gave some support, we can claim that state banks in the South and Southwest for the most part supported the bank. New England, contrary to expectations, showed the banks of Vermont and New Hampshire behind the bank, but support of Massachusetts was both qualitatively and quantitatively weak. The banks of the middle states all supported the second bank, except for those of New York." End quote. What then was the cause of the enormous monetary expansion of the 1830s? It was a tremendous and unusual expansion of the stockpile of specie in the nation's banks. The supply of specie in the country had remained virtually constant at about $32 million from the beginning of 1823 until the beginning of 1833. But the proportion of specie to banknotes held by the public as money dropped during this period from 23% to 5%, so that more specie flowed from the public into the banks to fuel the relatively moderate monetary expansion of the 1820s. But starting at the beginning of 1833, the total specie in the country rose swiftly from $31 million to $73 million at the beginning of 1837, for a rise of 141.9%, or 35.5% per annum. Hence, even though increasing distrust of banks led the public to withdraw some specie from them, so that the public now held 13% of its money in specie instead of 5%, the banks were able to increase their notes and deposits at precisely the same rate as the expansion of specie flowing into their coffers. Thus, the Jackson administration is absolved from blame for the 1833 to 1837 inflation. In a sense, the state banks are as well. Certainly, they scarcely acted as if being, quote, freed by the demise of the Bank of the United States. Instead, they simply increased their money issues proportionately with a huge increase of specie. Of course, the basic fractional reserve banking system is scarcely absolved from responsibility, since otherwise the monetary expansion in absolute terms would not have been as great. The enormous increase in specie was the result of two factors. First and foremost, a large influx of silver coin from Mexico, and second, the sharp cut in the usual export of silver to the Orient. The latter was due to the substantial increases in China's purchase of opium instead of silver from abroad. The influx of silver was the result of paper money inflation by the Mexican government, which drove Mexican silver coins into the United States, where they circulated as legal tender. The influx of Mexican coin has been attributed to a possible increase in the productivity of the Mexican mines, but this makes little sense since the inflow stopped permanently as soon as 1837. The actual cause was an inflation of the Mexican currency by the Santa Anna regime, which financed its deficits during this period by minting highly debased copper coins. Since the debased copper grossly overvalued copper and undervalued gold and silver, both the latter metals proceeded to flow rapidly out of Mexico until they virtually disappeared. Silver, of course, and not gold, was flowing into the United States during this period. Indeed, the Mexican government was forced to rescind its actions in 1837 by shifting the copper coinage to its proper ratio. The influx of Mexican silver into the U.S. promptly ceased. A bank credit inflation the magnitude of that of the 1830s is bound to run into shoals that cause the bank to stop the expansion and begin to contract. As the banks expand and prices rise, specie is bound to flow out of the country and into the hands of the domestic public, and the pressure on the banks to redeem in specie will intensify, forcing cessation of the boom and even monetary contraction. In a sense, the immediate precipitating cause is of minor importance. Even so, the Jackson administration has been unfairly blamed for precipitating the Panic of 1837 by issuing the Specie Circular in 1836. In 1836, the Jackson administration decided to stop the enormous speculation in Western public lands that had been fueled during the past 2 years by the inflation of bank credit. Hence, Jackson decreed that public land payments would have to be made in specie. This had the healthy effect of stopping public land speculation, but recent studies have shown that the specie circular had very little impact in putting pressure on the banks to pay specie. From the point of view of the Jackson program, however, it was as important as moving toward putting the U.S. government finances on a purely specie basis. Another measure advancing the Jacksonian program was also taken in 1836. Jackson, embarrassed at the government having amassed a huge budget surplus during his 8 years in office, ordered the Treasury to distribute the surplus proportionally to the states. The distribution was made in notes, presumably payable in specie. But again, Temin has shown that the distribution had little impact on movements of specie between banks and therefore in exerting contractionist pressure upon them. What then was the precipitating factor in triggering the Panic of 1837? Temin plausibly argues that the Bank of England, worried about inflation in Britain and the consequent outflow of gold, tightened the money supply and raised interest rates in the latter half of 1836. As a result, credit contraction severely restricted the American cotton export trade in London. Exports declined, cotton prices fell, capital flowed into England, and contractionist pressure was put upon American trade and the American banks. Banks throughout the United States, including the Bank of the United States, promptly suspended specie payments in May 1837. Their notes depreciated at varying rates, and interregional trade within the country was crippled. While banks were able to evade specie payments and continue operations, they were still obliged to contract credit in order to go back on specie eventually, since they could not hope to be creating fiat money indefinitely and be allowed to remain in business. Finally, the New York banks were compelled by law to resume paying their contractual obligations, and the other banks followed in the fall of 1838. During the year 1837, the money supply fell from $276 million to $232 million, a large drop of 15.6% in 1 year. Total specie in the country continued to increase in 1837, up to $88 million, but growing public distrust of the banks, reflected in an increase in the proportion of money held as specie from 13% to 23%, put enough pressure upon the banks to force the contraction. The bank's reserve ratio rose from 0.16 to 0.2. In response to the monetary contraction, wholesale prices fell precipitately by over 30% in 7 months, declining from 131 in February 1837 to 98 in September of that year. In 1838, the economy revived. Britain resumed easy credit that year, cotton prices rose, and a short-lived boomlet began. Public confidence in the banks unwisely returned as they resumed specie payment, and as a result, the money supply rose slightly during the year, and prices rose by 25%, increasing from 98 in September 1837 to 125 in February 1839. Leading the boom of 1838 were state governments, who, finding themselves with the unexpected windfall of a distributed surplus from the federal government, proceeded to spend the money wildly and borrow even more extravagantly on public works and other uneconomic reforms of, quote, investment. But the state governments engaged in rashly optimistic plans that their public works would be financed heavily from Britain and other countries, and the cotton boom on which these hopes depended collapsed again in 1839. The states had to abandon their projects en masse. Cotton prices declined, and severe contractionist pressure was put on trade. Furthermore, the Philadelphia-based Bank of the United States had invested heavily in cotton speculation, and the falling price of cotton forced the Bank of the United States, once again, to suspend payments in October 1839. This touched off a wave of general bank suspensions in the South and West, but this time the banks of New York and New England continued to redeem their obligations in specie. Finally, the Bank of the United States, having for the last time played a leading role in generating a recession and monetary crisis, was forced to close its doors 2 years later. With the crisis of 1839, there ensued 4 years of massive monetary and price deflation. Unsound banks were finally eliminated. Unsound investments generated in the boom were liquidated. The number of banks during these 4 years fell by 23%. The money supply fell from $240 million at the beginning of 1839 to $158 million in 1843. A seemingly cataclysmic drop of 34%, or 8.5% per annum. Prices fell even further, from $125 in February 1839 to 67 in March 1843, a tremendous drop of 42%, or 10.5% per year. During the boom, as we have indicated, state governments went heavily into debt, issuing bonds to pay for wasteful public works. In 1820, the total indebtedness of American states was a modest $12.8 million. By 1830, it rose to $26.5 million. But then it started to escalate, reaching $66.5 million in 1835 and skyrocketing to $170 million in 1839. The collapse of money, credit banking, and prices after 1839 brought these state debts into jeopardy. At this point, the Whigs, taking a leaf from their forebears, the Federalists, agitated for the federal government to bail out the states and assume their debts. After the crisis of 1839 arrived, some of the southern and western states were clearly in danger of default, their plight made worse by the fact that the bulk of the debt was held by British and Dutch capitalists, and that specie would have to be sent abroad to meet the heavy interest payments. The Whigs pressed further for federal assumption of the debt, with the federal government to issue $200 million worth of bonds in payment. Furthermore, British bankers put severe pressure on the United States to assume the state debts if it expected to float further loans abroad. The American people, however, spurned federal aid, including even the citizens of the states in difficulty, and the advent of the Polk administration ended any prospects for federal assumption. The British noted in wonder that the average American was far more concerned about his personal debts to other individuals and banks than about the debts of his state. In fact, the people were quite willing to have the states repudiate their debts outright. Demonstrating an astute perception of the reckless course the states had taken, the typical American response to the problem, quote, "Suppose foreign capitalists did not lend any more to the states," end quote, was the sharp retort, quote, "Well, who cares if they don't? We are now as a community heels over head in debt and can scarcely pay the interest," end quote. The implication was that the disappearance of foreign credit to the states would have the healthy effect of cutting off their wasteful spending, as well as avoiding the imposition of a crippling tax burden to pay for the interest and principal. There was in this response an awareness by the public that they and their government were separate and sometimes even hostile entities rather than one in the same organism. By 1847, 4 western and southern states, Mississippi, Arkansas, Michigan, and Florida, had repudiated all or part of their debts. 6 other states, Maryland, Illinois, Indiana, Louisiana, Arkansas, and Pennsylvania, had defaulted from 3 to 6 years before resuming payment. It is evident, then, that the 1839 to 1843 contraction was healthful for the economy in liquidating unsound investments, debts, and banks, including the pernicious Bank of the United States. But didn't the massive deflation have catastrophic effects on production, trade, and employment, as we have been led to believe? In a fascinating analysis and comparison with the deflation of 1929 to 1933, a century later, Professor Temin shows that the percentage of deflation over the comparable 4 years, 1839 to 1843 and 1929 to 1933, was almost the same. Yet the effects on real production of the two deflations were very different. Whereas in 1929 to 1933, real gross investment fell catastrophically by 91%, real consumption by 19%, and real GNP by 30%, in 1839 to 1843, investment fell by 23%, but real consumption increased by 21% and real GNP by 16%. The interesting problem is to account for the enormous fall in production and consumption in the 1930s as contrasted to the rise in production and consumption in the 1840s. It seems that only the initial months of the contraction worked a hardship on the American public, and that most of the earlier deflation was a period of economic growth. Temin properly suggests that the reason can be found in the downward flexibility of prices in the 19th century, so that the massive monetary contraction would lower prices but not particularly cripple the world of real production or standards of living. In contrast, in the 1930s, government placed massive roadblocks on the downward fall of prices and wage rates, and hence brought about severe and continuing depression of production and living standards. The Jacksonians had no intention of leaving a permanent system of pet banks, and so after the retirement of Jackson, his successor, Martin Van Buren, fought to establish the independent Treasury system, in which the federal government conferred no special privilege or inflationary prop on any bank. Instead of a central bank or pet banks, the government was to keep its funds purely in specie in its own Treasury vaults, or its, quote, sub-Treasury branches,
and simply take in and spend funds from there. Van Buren finally managed to establish the independent Treasury system, which would last until the Civil War. At long last, the Jacksonians had achieved their dream of severing the federal government totally from the banking system and placing its finances on a purely hard money, specie basis. The Jacksonians and the Coinage legislation of 1834. We have seen that the Coinage Act of 1792 established a bimetallic system in which the dollar was defined as equaling both 371.25 grains of pure silver and 24.75 grains of pure gold, a fixed weight ratio of 15 grains of silver to 1 grain of gold. But bimetallism foundered on Gresham's law. After 1805, the world market value of silver fell to approximately 15.75 to 1, so that the U.S. fixed mint ratio greatly undervalued gold and overvalued silver. As a result, gold flowed out of the country and silver flowed in, so that after 1810 only silver coin, largely overvalued Spanish-American fractional silver coin, circulated within the United States. The rest of the currency was inflated bank paper in various stages of depreciation. The Jacksonians, as we have seen, were determined to eliminate inflationary paper money and substitute a hard money consisting of specie, or, at the most, of paper 100% backed by gold or silver. On the federal level, this meant abolishing the Bank of the United States and establishing the independent Treasury. The rest of the fight would have to be conducted during the 1840s and later at the state level where the banks were chartered. But one thing the federal government could do was readjust the specie coinage. In particular, the Jacksonians were anxious to eliminate small denomination banknotes, $20 and under, and substitute gold and silver coins for them. They reasoned that the average American largely used these coins, and they were the ones bilked by inflationary paper money. For a standard to be really gold and silver, it was vital that gold or silver coins circulate and be used as a medium of exchange by the average American. To accomplish this goal, the Jacksonians set about to establish a comprehensive program. As a vital step, one of the Coinage Acts of 1834 readjusted the old mint ratio of 15 to 1 that had undervalued gold and driven it out of circulation. The Coinage Act devalued the definition of the gold dollar from the original 24.75 grains to 23.2 grains, a debasement of gold by 6.26%. The silver dollar was left at the old weight of 371.25 grains, so that the mint ratio between silver and gold was now fixed at a ratio of 16 to 1, replacing the old 15 to 1. It was unfortunate that the Jacksonians did not appreciate silver to 396 grains instead of debasing gold, for this set a precedent for debasement that was to plague America in 1933 and after. The new ratio of 16 to 1, however, now undervalued silver and overvalued gold, since the world market ratio had been approximately 15.79 to 1 in the years before 1834. Until recently, historians have assumed that the Jacksonians deliberately tried to bring in gold and expel silver and establish a monometallic gold standard by the back door. Recent study has shown, however, that the Jacksonians only wanted to give gold inflow a little push through a slight undervaluation, and that they anticipated a full coin circulation of both gold and silver. In 1833, for example, the world market ratio was as high as 15.93 to 1. Indeed, it turns out that for 2 decades the Jacksonians were right, and that the slight 1% premium of silver over gold was not enough to drive the former coins out of circulation. Both silver and gold were imported from then on, and silver and gold coins both circulated successfully, side by side, until the early 1850s. Lightweight Spanish fractional silver remained overvalued even at the mint ratio, so it flourished in circulation, replacing depreciated small notes. Even American silver dollars were now retained in circulation since they were, quote, shielded, and kept circulating by the presence of new, heavyweight Mexican silver dollars, which were exported instead. In order to stimulate the circulation of both gold and silver coins instead of paper notes, the Jacksonians also passed 2 companion Coinage Acts in 1834. The Jacksonians were not monetary nationalists. Specie was specie, and they saw no reason that foreign gold or silver coins should not circulate with the same full privileges as American minted coins. Hence, the Jacksonians, in 2 separate measures, legalized the circulation of all foreign silver and gold coins, and they flourished in circulation until the 1850s. A third plank in the Jacksonian coinage program was to establish branch U.S. mints so as to coin the gold found in newly discovered mines in Georgia and North Carolina. The Jackson administration finally succeeded in getting Congress to do so in 1835, when it set up branch mints to coin gold in North Carolina and Georgia, and silver and gold at New Orleans. Finally, on the federal level, the Jacksonians sought to levy a tax on small banknotes and to prevent the federal government from keeping its deposits in state banks, issuing small notes, or accepting small banknotes in taxes. They were not successful, but the independent Treasury eliminated public deposit in state banks, and the specie circular, as we have seen, stopped the receipt of banknotes for public land sales. From 1840 on, the hard money battle would be waged at the state level. In the early 1850s, Gresham's law finally caught up with the bimetallist idol that the Jacksonians had forged in the 1830s, replacing the earlier de facto silver monometallism. The sudden discovery of extensive gold mines in California, Russia, and Australia greatly increased gold production, reaching a peak in the early 1850s. From the 1720s through the 1830s, annual world gold production averaged $12.8 million, never straying far from that norm. Then, world gold production increased to an annual average of $38.2 million in the 1840s, and spurted upward to a peak of $155 million in 1853. World gold production then fell steadily from that peak to an annual average of $139.9 million in the 1850s and to $114.7 million from 1876 to 1890. It was not to surpass this peak until the 1890s. The consequence of the burst in gold production was, of course, a fall in the price of gold relative to silver in the world market. The silver-gold ratio declined from 15.97 in January 1849 to an average of 15.7 in 1850 to 15.46 in 1851 and to an average of 15.32 to 1 in the 8 years from 1853 to 1860. As a result, the market premium of American silver dollars over gold quickly rose above the 1% margin, which was the estimated cost of shipping silver coins abroad. That premium, which had hovered around 1% since the mid-1830s, suddenly rose to 4.5% at the beginning of 1851, and after falling back to about 2% at the turn of 1852, bounced back up and remained at the 4 to 5% level. The result was a rapid disappearance of silver from the country, the heaviest and therefore most undervalued coins vanishing first. Spanish milled dollars, which contained 1% to 5% more silver than American dollars, commanded a premium of 7% and went first. Then went the full-weight American silver dollars, and after that, American fractional silver coins, which were commanding a 4% premium by the fall of 1852. The last coins left were the worn Spanish and Mexican fractions, which were depreciated by 10 to 15%. By the beginning of 1851, however, even these worn foreign silver coins had gone to a 1% premium and were beginning to go. It was clear that America was undergoing a severe small coin crisis. Gold coins were flowing into the country, but they were too valuable to be technically usable for small denomination coins. The Democratic Pierce administration saw with horror millions of dollars of unauthorized private small notes flood into circulation in early 1853 for the first time since the 1830s. The Jacksonians were in grave danger of losing the fight for hard money coinage, at least for the smaller and medium denominations. Something had to be done quickly. The ultimate breakdown of bimetallism had never been clearer. If bimetallism is not in the long run viable, this leaves two free market, hard money alternatives. A. Silver monometallism with the dollar defined as a weight of silver only, and gold circulating freely by weight at freely fluctuating market rates. Or B. Gold monometallism with the dollar defined only as a weight of gold, with silver circulating by weight. Each of these is an example of what has been called, quote, parallel standards, or, quote, free metallism, in which two or more metal coins are allowed to fluctuate freely within the same area and exchange at free market prices. As we have seen, colonial America was an example of such parallel standards, since foreign gold and silver coins circulated freely and at fluctuating market prices. The United States could have taken this opportunity of monetary crisis to go on either version of a parallel standard. Apparently, however, few thought of doing so. Another viable, though inferior, solution to the problem of bimetallism was to establish a monometallic system, either de facto or de jure, with the other metal circulating in the form of lightweight and therefore overvalued or, quote, token coinage. Silver monometallism was immediately unfeasible since it was rapidly flowing out of the country, and because gold, being far more valuable than silver, could not technically function easily as a lightweight subsidiary coin. The only feasible solution, then, within a monometallic framework, was to make gold the basic standard and let highly overvalued, essentially token, silver coins function as subsidiary small coinage. Certainly, if a parallel standard was not to be adopted, the latter solution would be far better than allowing depreciated paper notes to function as small currency. Under pressure of the crisis, Congress decided, in February 1853, to keep the de jure bimetallic standard, but to adopt a de facto gold monometallic standard, with fractional silver coins circulating as a deliberately overvalued subsidiary coinage, legal tender up to a maximum of only $5. The fractional silver coins were debased by 6.91%. With silver commanding about 4% market premium over gold, this meant that fractional silver was debased 3% below gold. At that depreciated rate, fractional silver was not overvalued in relation to gold and remained in circulation. By April, the new subsidiary quarter dollars proved to be popular, and by early 1854, the problem of the shortage of small coins in America was over. In rejecting proposals either to go over completely to de jure gold monometallism or to keep the existing bimetallic system, Congress was choosing a gold standard temporarily, but keeping its options open. The fact that it continued the old full-bodied silver dollar, the quote, dollar of our fathers, demonstrates that an eventual return to de facto bimetallism was by no means being ruled out, albeit Gresham's law could not then maintain the American silver dollar in circulation. In 1857, an important part of the Jacksonian coinage program was repealed, as Congress, in an exercise of monetary nationalism, eliminated all legal tender power of foreign coins. Decentralized banking from the 1830s to the Civil War. After the central bank was eliminated in the 1830s, the battle for hard money largely shifted to the state governmental arena. During the 1830s, the major thrust was to prohibit the issue of small notes, which was accomplished for notes under $5 in 10 states by 1832, and subsequently, 5 others restricted or prohibited such notes. The Democratic Party became ardently hard money in the various states after the shock of the financial crisis of 1837 and 1839. The Democratic drive was toward the outlawry of all fractional reserve bank paper. Battles were fought also in the late 1840s at constitutional conventions of many states, particularly in the West. In some Western states, the Jacksonians won temporary success, but soon the Whigs would return and repeal the bank prohibition. The Whigs, trying to find some way to overcome the general revulsion against banks after the crisis of the late 1830s, adopted the concept of, quote, free banking, which had been enacted by New York and Michigan in the late 1830s. From New York, the idea spread outward to the rest of the country and triumphed in 15 states by the early 1850s. On the eve of the Civil War, 18 out of 33 states in the Union had adopted, quote, free banking laws. It must be realized that, quote, free banking, as it came to be known in the United States before the Civil War, was unrelated to the philosophic concept of free banking analyzed by economists. As we have seen earlier, genuine free banking is a system where entry into banking is totally free. The banks are neither subsidized nor regulated, and at the first sign of failure to redeem in specie payments, a bank is forced to declare insolvency and close its doors. Quote, free banking before the Civil War, on the other hand, was very different. As we have pointed out, the government allowed periodic general suspensions of specie payments whenever the banks overexpanded and got into trouble. The latest episode was in the Panic of 1857. It is true that bank incorporation was now more liberal, since any bank that met the legal regulations could become incorporated automatically without lobbying for special legislative charters, as had been the case before. But the banks were now subject to a myriad of regulations, including edicts by state banking commissioners and high minimum capital requirements that greatly restricted entry into the banking business. But the most pernicious aspect of, quote, free banking was that the expansion of banknotes and deposits was directly tied to the amount of state government securities that the bank had invested in and posted as bond with the state. In effect, then, state government bonds became the reserve base upon which banks were allowed to pyramid a multiple expansion of banknotes and deposits. Not only did the system provide explicitly or implicitly for fractional reserve banking, but the pyramid was tied rigidly to the amount of government bonds purchased by the banks. This provision deliberately tied banks and bank credit expansion to the public debt. It meant that the more public debt the banks purchased, the more they could create and lend out new money. Banks, in short, were encouraged to monetize the public debt. State governments were thereby encouraged to go into debt, and hence, government and bank inflation were intimately linked. In addition to allowing periodic suspension of specie payments, federal and state governments conferred upon the banks the privilege of their notes being accepted in taxes. Moreover, the general prohibition of interstate branch banking, and often of intrastate branches as well, greatly inhibited the speed by which one bank could demand payment from other banks in specie. In addition, state usury laws, pushed by the Whigs and opposed by the Democrats, made credit excessively cheap for the riskiest borrowers and encouraged inflation and speculative expansion of bank lending. Furthermore, the desire of state governments to finance internal improvements was an important factor in subsidizing and propelling expansion of bank credit. As Hammond admits, quote, "The wildcats lent no money to farmers and served no farmer interest. They arose to meet the credit demands not of farmers, who were too economically astute to accept wildcat money, but of states engaged in public improvements." End quote. Despite the flaws and problems, the decentralized nature of the pre-Civil War banking system meant banks were free to experiment on their own with improving the banking system. The most successful such device was the creation of the Suffolk system, a free market central bank. It is a fact, almost never recalled, that there once existed an American private bank that brought order and convenience to a myriad of privately issued banknotes. Further, this Suffolk Bank restrained the overissuance of these notes. In short, it was a private central bank that kept the other banks honest. As such, it made New England an island of monetary stability in an America contending with currency chaos. Chaos was, in fact, that condition in which New England found herself just before the Suffolk Bank was established. There was a myriad of banknotes circulating in the area's largest financial center, Boston. Some were issued by Boston banks, which all in Boston knew to be solvent, but others were issued by state-chartered banks. These could be quite far away, and in those days such distance impeded both general knowledge about their solvency and easy access in bringing the bank's notes in for redemption into gold or silver. Thus, while at the beginning these country notes were accepted in Boston at par value, this just encouraged some faraway banks to issue far more notes than they had gold to back them. So country banknotes began to be generally traded at discounts to par of from 1% to 5%. City banks finally refused to accept country banknotes altogether. This gave rise to the money brokers mentioned earlier in this chapter. But it also caused hardship for Boston merchants, who had to accept country notes whose real value they could not be certain of. When they exchanged the notes with the brokers, they ended up assuming the full cost of discounting the bills they had accepted at par. A false start. Matters began to change in 1814. The New England Bank of Boston announced it too would go into the money broker business, accepting country notes from holders and turning them over to the issuing bank for redemption. The note holders, though, still had to pay the cost. In 1818, a group of prominent merchants formed the Suffolk Bank to do the same thing. This enlarged competition brought the basic rate of country note discount down from 3% in 1814 to 1% in 1818, and finally to a bare 0.5% in 1820. But this did not necessarily mean that country banks were behaving more responsibly in their note creation. By the end of 1820, the business had become clearly unprofitable, and both banks stopped competing with the private money brokers. The Suffolk became just another Boston bank. Operation begins. During the next several years, city banks found their notes representing an ever smaller part of the total New England money supply. Country banks were simply issuing far more notes in proportion to their capital, that is, gold and silver, than were the Boston banks. Concerned about this influx of paper money of lesser worth, both Suffolk Bank and New England Bank began again in 1824 to purchase country notes. But this time they did so not to make a profit on redemption, but simply to reduce the number of country notes in circulation in Boston. They had the foolish hope that this would increase the use of their better notes, thus increasing their own loans and profits. But the more they purchased country notes, the more notes of even worse quality, particularly from faraway Maine banks, would replace them. Buying these latter involved more risk, so the Suffolk proposed to 6 other city banks a joint fund to purchase and send these notes back to the issuing bank for redemption. These 7 banks, known as the Associated Banks, raised $300,000 for this purpose. With the Suffolk acting as agent and buying country notes from the other 6, operations began March 24, 1824. The volume of country notes brought in this way increased greatly to $2 million per month by the end of 1825. By then, Suffolk felt strong enough to go it alone. Further, it now had the leverage to pressure country banks into depositing gold and silver with the Suffolk to make note redemption easier. By 1838, almost all banks in New England did so and were redeeming their notes through the Suffolk Bank. The Suffolk ground rules from beginning 1825 to end 1858 were as follows. Each country bank had to maintain a permanent deposit of specie of at least $2,000 for the smallest bank, plus enough to redeem all its notes that Suffolk received. These gold and silver deposits did not have to be at Suffolk as long as they were at some place convenient to Suffolk, so that the notes would not have to be sent home for redemption. But in practice, nearly all reserves were at Suffolk. City banks had only to deposit a fixed amount, which decreased to $5,000 by 1835. No interest was paid on any of these deposits. But, in exchange, the Suffolk began performing an invaluable service. It agreed to accept at par all the notes it received as deposits from other New England banks in the system, and credit the depositor bank's accounts on the following day. With the Suffolk acting as a, quote, clearing bank, accepting, sorting, and crediting banknotes, it was now possible for any New England bank to accept the notes of any other bank, however far away and at face value. This drastically cut down on the time and inconvenience of applying to each bank separately for specie redemption. Moreover, the certainty spread that the notes of the Suffolk member banks would be valued at par. It spread at first among other bankers, and then to the general public.